Good morning. I want to welcome everyone participating in this morning's webinar. My name is Patrick Crosby. I'm a senior tax accountant at Gelman, Rosenberg and Friedman, and I will be today's moderator. I'd like to start off today with some quick housekeeping items and explain what participants need to do to earn CPE credit for today's webinar. For the best sound quality, we highly recommend that you connect by phone instead of by computer. If you have any technical questions or issues during the webinar, please use the questions function to speak with our webinar administrator for assistance. Please note this webinar will be recorded and made available on our website following the event. The slides will also be posted at the address found at the bottom of the slide. Webinar participants seeking CPE credit for this presentation must complete and submit a short evaluation survey that will appear automatically immediately following the webinar. Please write down the CPE words when they are given. They will not be provided again. You will be asked to recall these words in order to receive credit. If you have an active pop-up blocker, please take a moment and disable it now so that it will not block the survey. Any technical questions about the survey may be addressed to Dominic Acosta at dacosta@grfcpa.com. As the title of the webinar implies, today's learning objective is to provide attendees with a better understanding of the steps business owners should take now before deciding to sell or transfer a business. One CPE credit is available to attendees of today's webinar. With all of that said, welcome to today's webinar, the exit checklist, 5 steps to a happy and lucrative exit from your business. I'd like to introduce our speakers today, Walter Dial and Pat Ennis. Walter Dial is a senior tax partner and the director of GRF's Valuation and Exit Planning Division. Walter addresses particularly complex tax issues with clients concerning investments, estate and gift taxes, with a specific concentration in helping business owners transition their businesses. Pat Ennis is the founder and president of Ennis Legacy Partners, with decades of experience in financial services, for-profit and nonprofit leadership and management, along with the founding of ELP in 2010. Pat has extensive knowledge and understanding of the many challenges faced by business owners. We have come to our first polling question today. The question reads, how many years until you are ready exit? A, 1 to 3 years, B, 3 to 5 years, C, 5 or more years. Please take a moment now to answer. While participants are recording their answers, I will provide the first CPE word. The first CPE word is exit. If you want to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the first CPE word is exit, E-X-I-T. And with that, I will turn the presentation over to Walter.
Thank you very much, Patrick. These are interesting answers. I think Pat will agree, it's nice to see that no one's in the 1 to 3 year category, or at least if they are, they're not admitting to it. Because as we've talked about in many other webinars, it's really important to start exit planning as soon as you can. So for the people with the 3 to 5 year window, and especially with those 5 year plus window, that's really good. So let's go ahead and start our presentation. While there are many important considerations as you start to plan the exit from your business, I think there's sort of 2 overarching questions to consider. And the first, as you can see in box 1, is your business ready to sell? And this is the one, Pat and I have done a number of previous webinars, based on this topic. And I think as business consultants, this is probably the area that we tend to spend most of our time. And as we've talked about previously, we use the Value Builder system, which gives us a really great Value Builder score, which rates how sellable your business is. And even more importantly, it highlights the areas that are either strengths or weaknesses so that we're able to develop a really great roadmap to help increase the value and the sellability of the business. But there's a second question that is at least as important, and maybe actually more important, and that is, are you personally ready to exit, as you can see in box 2? And I think a lot of business owners just kind of assume that if the answer to 1 is yes, then the answer to number 2 is yes also. But these really are two very separate issues. And when we talk about are you personally ready to exit, I mean, there is certainly a financial component to that, and we're going to hit on that today. But I think at least as importantly, and again, maybe more importantly, it's a question of, is the business owner ready mentally and psychologically to move into their next stage of life? Because going from a business owner to someone who no longer owns a business is a dramatic change in life. And it has amazing repercussions really in all aspects of your life. So what we've seen is, business owners who haven't really thought about what their next act is going to look like, they haven't really envisioned the rest of their life, the transition from business owner to non-business owner can be very, very difficult. So what we're going to be talking about today is a 5-step exit checklist. And this is going to help you start to wrap your mind around whether you are personally ready to exit and what steps you need to take. If you're not, what steps you need to take to get there. So let's go ahead and start. I'll turn it over to Pat to address step 1.
So in step 1 of our exit checklist, we want to get clear on our why. Why are you thinking about exit and why you would want to exit? In order to decide how to exit, you first need to be clear on your why you want to exit. And we have found that you can categorize reasons or factors into 2 categories. First, what we call the push factors. Push factors are things that might be pushing you away from your business. And then the pull factors, which are things that are pulling you away from the business. Some examples of push factors might be the market has peaked, you're aware of that, and you want to cash out and move on. You might have health issues, either personally or in the family, that need a lot of attention and time. You might want to diversify your overall investment portfolio. It's not usual for an owner's business to be the largest investment in their portfolio. And so you may be at a point in life where you're more risk averse and want to diversify. Or you may be bored, stressed out, and just feel the need to get out of the business as soon as possible. So those are some examples of push factors. And then examples of pull factors would be maybe you're charitably motivated and want to start a foundation or do more charity work. You may want to start a new business. Perhaps traveling the world is something you've always wanted to do and you want to get started on it now as soon as possible. Maybe your health and getting in shape is what you want or need to do and most focus on in the next season of life. Perhaps you just simply want to retire. In doing the work that we do, Walter and I, a consistent theme when observing successful and happy exits is that there are as many, if not more, of these pull factors that influence the exiting owner as there were push factors. Most owners exit, Walter mentioned this earlier, without a plan for life after the business and end up not being happy within 2 years. And think about that. In building a successful business, you've experienced a sense of purpose, meaning, significance. And if you don't have a clear plan to replace that after you've left the business, you could very well end up not being happy at all or fulfilled, even if your exit was financially successful. And so being clear on these pull factors will help you to remain steadfast in doing the needed work and planning to exit successfully. So the first exercise we want you to do in step 1 is to take some time to create a list of the things that you're excited to do when you leave. Take a piece of paper, simple exercise, take a piece of paper, draw a line down the middle. Title one column is push factors, the other is pull factors. Begin to create a list in each column. And the hope or goal would be to have as many pull factors or things you're excited about as you do things that are pushing you or that you might be frustrated with. And if there aren't as many pull factors, start now to give serious consideration to the things that could indeed excite you after the business. Again, a consistent theme that we've observed over and over with happy exits is that there are strong pull factors influencing the owner to leave the business. And in step 2, I think Patrick's got a poll question.
Yeah, so we have our second polling question now, which is a follow-up to the previous polling question. The question reads, when was your business last valued? A, within the last 5 years. B, more than 5 years. C, never. So please take a moment now to answer. While participants are recording their answers, I'll provide the second CPE word. The second CPE word is owner. If you want to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the second CPE word is owner, O-W-N-E-R.
And there are the results. When was your business last valued? Within the last 5 years, 25%, more than 5 years, 0%, never, 75%. You know, we can't strongly encourage you. Before I launch into step 2 here, a couple of comments around valuation. We can't strongly encourage you enough to get an objective valuation of what might possibly be and probably is your largest asset. All meaningful planning requires meaningful data. And so often when Walter, I know you would attest to this, when we get involved in an exit planning situation, this proves to be true, that owner has never had their business, which is their largest asset, and in most cases that we're dealing with, ever evaluated. So strong encouragement to do that. Walter, before I launch into step 2, is there anything that you would add to what I just said?
No, I would just echo that same sentiment, Pat, how important it is to get a business valuation. Even if you don't get a full-blown certified valuation, you really need to at least get more than a back of the envelope. We perform different levels of valuation services, so I would definitely encourage business owners to at least engage a valuation professional to do the lowest level of valuation.
Good. So in step 2, and again, these 5 steps are mostly focused on getting you personally ready to exit. Step 1 was working on clarifying your why for exit. Step 2, we want to help you start to think about how to align your exit route with whatever your why is. So helping you get clear on your why, you can then begin to figure out the how of how you should exit the business. Which exit route is best going to accomplish your goals? How do you want to exit? Which exit route should you choose? And some different options or different routes would include, well, an outright sale. When most owners think of their exit, they think of selling outright to a third party and riding off into the sunset with a big check. That doesn't happen a whole lot. But an example of that would be a strategic buyer maybe coming into a new market, new geographic area, and buying up other like companies. So an outright sale, of course, is an option. Recapitalization would be another option, and that's typically led by a private equity firm, either buying a minority or a majority stake of your business. This can be ideal for an owner who wants to take some chips off the table, but remain involved and even in control of the business, and perhaps wants a second bite of the apple downstream. Liquidation can actually work well for an owner who simply wants out now. Maybe you have another business opportunity that you want to focus on and are willing to receive a discounted sale price so that you can move on. However, let me mention this about liquidation. Too often, this particular option we've observed is the default option due to a lack of planning. And so it can end up being a fire sale instead because it ends up being the default. And it's frequently the least favorable, but it can work in specific situations. You might hire a COO and then truly act as a CEO. You would bring in a chief operating officer. You would act more as the true strategic CEO. The COO would handle all the day-to-day operational details, and you would think and plan strategically for the business. Or perhaps you'd want to be perhaps a key owner and only act as the chairman of the board. In this case, you'd bring in a CEO and completely remove yourself from the day-to-day running of the business, including both strategy and operations. Or you might have children in the business who you want to transfer the business to. Now, of course, it would be essential that those children would want to own the business, which is often not the case these days, and that they are capable of being owners. Too often, we parents can be very generous in our assessment of our children's skills and abilities, and we need to be very careful of that. And then perhaps maybe a management buyout. You have management or employees who have helped build the business, and they've expressed a desire to buy it, and they've proven capable to be owners. So these are options. And in order to know which of these exit routes is best for you, you first need to do that work in step one of knowing your why, because some of the whys will translate more directly into specific exit routes. For example, if you want to retire as soon as possible, then selling to a strategic who wants to buy your company or transferring to your kids could make sense. If you think the market has peaked indeed, and you want to get out completely and immediately with as much money as possible, then selling to a strategic buyer is probably going to be your best route. Or perhaps you want to diversify your risk, your overall portfolio, and become more risk averse. Then recapitalization might be your best bet. Maybe you're bored or stressed to the point where getting out quickly is what you want to do, and liquidation at a discounted price would make the most sense for you. So again, know your why and then assess which of these routes most aligns with it. That's step two. Now, Walter, in step three is going to help you know how to figure out your number.
Thanks, Pat. So step three, as Pat mentioned, is all about figuring out your number. So we're going to take a look at three ways to do this. But first, let's kind of do a little overview. So there's two really important numbers. One is, what is your business worth to a buyer? And the other is, what do you need to get out of your business to have a financially successful exit? And those two numbers can be drastically different. So it's important, as we talked about earlier, to have a credible business valuation done so you can answer the question, what is my business worth? But it's also very important to go through an analysis to see what you need to get out of your business to exit successfully. Now, when you do this analysis, I think in pretty much every case Pat and I have worked with, except maybe there's a few exceptions, there's been a gap between what the owner needs to get out of the business and what the business was worth. So at first, that can be disappointing or upsetting to the owner, but it's a lot better to find that out 3 to 5 to 7 years before your exit, as opposed to finding it out 30 days before you decide that you're getting out of your business. So, I like to say knowledge is power. So even if there's a gap, knowing that, and then having the ability and the time to take steps to grow the value of your business, or maybe even address your retirement expenses, you can do it either way to narrow that gap. That's fine. As long as you have time to remedy the problem, you're so much better off knowing that a problem exists than probably 75% of the business owners out there who have a problem and don't realize it. And they're going to be really in a crisis situation if they wait until the last minute to discover that there's a big gap between what they need and what the business is really worth. So we're going to take a look at 3 different ways to come up with what we call your number. The first one we're going to look at, I think, is the one that we tend to see the most, and I find really to be the most useful. Now, one thing as we go through these 3 examples, because no one likes math, even though I'm a CPA, we're going to keep this simple. We are going to address what we call the frictional costs of selling your business in a few slides, but for these 3 examples, we're going to keep everything really, really simple. We're not going to worry about gross proceeds versus net proceeds and that type of thing at this point. So let's look at the first example, figuring out your number. And like I mentioned, this is the one I would say that I see most often. I really find this very, very helpful because it's kind of easy to understand and it makes sense. So let's just say you've sat down and you've kind of run through what you anticipate your expenses to be in retirement, and you come up with a $100,000 number. There's kind of a famous rule of thumb that, you'll read in the press sometimes that, it's not that great, but actually the guy who came up with it won a Nobel Prize in economics for it, and it is actually proven to be very reliable over, I think it's been over 20 years. And what they call that is the rule, it's basically a rule of 4%. So the idea is that assuming you retire in your mid-60s, something like that, you should be able to draw down your nest egg at a rate of 4%, and it should last you for the rest of your life. And again, it's a general rule of thumb. Obviously, things can change, but it's what I consider to be a really good starting point, just to kind of help you figure out your number. So if you can draw 4% successfully for the rest of your life, that's the same thing as multiplying your $100,000 times 25. So that's going to give you 2.5 million. So that's the amount of money that you need to retire successfully from a financial standpoint. Then hopefully you have some investments outside of your business, things like your 401k, maybe some other investments. We would not include the equity in your home in this number because you're going to have to live somewhere, and it also makes the calculation a little more conservative if we exclude that. So in my example here, we're saying that the business owner, in addition to in addition to needing $2.5 million, he currently has about $700,000 in 401ks and other investments. So that means he needs to net $1.8 million from the sale of his business. So just a couple other points about this analysis. One is, we don't factor in things like Social Security. You certainly can. We usually don't, just to be conservative. The other important point is that if we were really sitting down with a real client and doing this, while we may start out with this calculation just to kind of get an idea of the ballpark that they're in, we would do what's called a Monte Carlo simulation, which it would start by really drilling down on the income number that the business owner feels they need to fund their lifestyle, because sometimes they're not aware that even their expenses can change dramatically once they're no longer business owners. It may be that their auto, their country club, their cell phone, health insurance, all this stuff's being paid by the business. Well, it may turn out that once they're no longer business owners, that they have to start paying a lot more expenses themselves. Also, it's not unusual to see a business owner and their spouse start to travel a lot, especially in the early years after retirement. They've been working hard all their life, and they decide that, rightfully so, they want to go out and enjoy themselves. So, a lot of things you read about, it's, you should estimate your retirement expenses at like 65 or 75% of your non-retirement expenses. But we tend to see that expenses do not go down that dramatically in retirement for most of our clients. So that's an important factor. And then with the way the Monte Carlo simulation works is, rather than using this rule of 4%, Monte Carlo simulations actually take your nest egg and they run it through up to 50,000 different samples of what the markets have actually returned over the last 50 years. And it comes up with, at the end, you have a probability of success score. We try to shoot for is that the probability of success is at least 97%. Ideally, it would be 100%, but usually 97% is good enough. So this is What you're looking at here, like I said, is really just kind of a back of the envelope type calculation, but it's still very helpful. We would just go into much more detail in a real engagement. Another way to look at your number, and this goes back to when Pat was talking about some of the different ways to exit your business. One of the ones he mentioned was a recapitalization. And as Pat said, one of the reasons for doing a recapitalization is to take some of your wealth that's tied up in the business and get it out of the business so that you're not in such a risky situation from a portfolio standpoint. So this example here would give someone an idea of how to calculate the amount of their business that they can keep in a recapitalization and reach their targets as far as risk aversion. So in this example, we're saying that the business owner has determined that he wants no more than 30% of his net worth tied up in the business. His total net worth right now is $5 million. The business represents 3.5 million of that, or 70%. So clearly he's above his 30% goal. So in order to get him down to 30%, he would have to sell 58% of his business. He could retain 42%. And if he did that, he'd end up exactly where he wants to be. His net worth obviously would stay at 5 million. The business would now, his 42% interest would only be worth 1.5, and his other assets would be worth 3.5 million. So this is just an example of what to do if you're looking at a recapitalization to try to minimize your risk. And then the final calculation we do is a little bit of an odd one, I think, but I have actually had to use it in practice. And the times I've used it have not been great situations. It's been, in both cases, it was a situation where a client had a great idea, and sometimes they really were great ideas, other times they weren't so great ideas. But for whatever reason, after a period of anywhere from 4 to 8 years of trying to make this business successful, it just didn't work out. And they've come in and they've said, look, we've tried, it's not working, we'd like to sell the business. And you can obviously, if it's not working, chances are the business is not all that valuable. Now, Pat did mention that you might also do this scenario if you have a successful business but you're bored. Unfortunately, I haven't really seen that situation. So the one I've dealt with is the one where the people are just kind of burned out. So what happens is they come in and they say, I want to sell the business, but I really feel like I've spent the last, in this example, 7 years of my life really working hard to make a go of it, and it hasn't worked out, but I would at least like to get an amount equal to the time I've invested when I sell my business. So this is how to do that calculation. So in this example, they've worked in the business for 7 years. Market rate compensation at their level would be about $200,000. Because of cash flow limitations in the business, they've only been able to pay themselves $120,000. So they've been short about $80,000 a year, worked in the business 7 years. So in total, they're $560,000 short. You would also add the cash that you've invested in the company. In my example, it's all sweat equity. So they've determined that if they can at least get $560,000 for the business, while they might not be thrilled, they'll at least be satisfied. Now, like I mentioned, in the situations I was dealing with, the businesses were not worth nearly, in this example, $560,000. And you can kind of think of it this way. A buyer, what they care about is the return on investment. So what they're looking at is, what is the business worth to them as an investment? So the amount of money that you want to get out of it, or that you think it's worth, is really totally irrelevant to the equation, at least from their perspective. It's going to affect you emotionally, but someone who thinks your business is worth, in this example, $400,000 is not going to give you $560 because that's what you want. So usually if you're doing this calculation, it's not a happy situation, but it is something you can look at, and maybe you can make yourself feel better if you're at least getting out the time that you invested into it. So those are kind of three ways to look at and figure out what your number is. So I mentioned early on that these last 3 slides were all very simplistic from a business sales standpoint. They didn't include a lot of the expenses associated with a sale. So let's go ahead and take a look at that, because I think it's going to be probably kind of eye-opening for people. So in this example, let's just say you're selling your business for $3.5 million. Normally, you're going to hire an intermediary to sell your business, and in a business of this price range, probably anywhere from $1 to $10 million, you're probably looking at the fee schedule that you see there next to the intermediary fee, where it says 10% of first million, 8% on second million, and 6% on the third million. If you have a much larger business, that's going to those fees are going to drop some. But in this example, the 3.5 million sales price, you're paying $260,000 to the intermediary. Then the legal fees normally associated with a deal are probably 2 to 4%. So in this case, that's another $80,000. Then you may have employee thank yous, and this is a situation where the business has continued to be owned 100% by the sole owner, or the original group of owners. They've never distributed ownership to any employees, so they may have employees who've been with them forever and who are very much responsible for the value of the firm. So as a thank you, they may carve out some of those sales proceeds and give them to the employees. They also may be situations where employment agreements call for sales proceeds to be shared with employees, or there could be, in more sophisticated situations, there may be phantom stock options where the holders of those phantom stock options are entitled to a portion of the proceeds. So in this example, we just said, let's just say 10% of that, of the sales price, is used for these type of employee thank yous. So you do the math and subtract out those 3 costs, you end up with net proceeds, and this is before taxes, of just over 2.8 million. Then you need to pay taxes. So generally taxes are going to run about 30%, unless you're really smart and you managed to move to Florida right before you sold your business. So the 30% is going to represent about a 23 to 24% federal capital gain rate, and another 5 to 7% state tax. So that's $843,000. So when all is said and done, you started with a $3.5 million sales price, and you're down to net proceeds of $1,967,000. So you've lost over 40% of your gross sales price to arrive at your net. So that's, can be pretty eye-opening for people. If you go back to our very first slide, the guy needed, I think, 1.8 million. That means he'd have to sell for about 3 million to get that. So there's a dramatic difference between net sales price and gross sales price. And there are strategies that we can employ to help reduce, for instance, the tax hit, maybe using some charitable planning, or transferring the business to kids or estates or grats, stuff like that ahead of time. There's also there's a new thing that the new tax law put in called opportunity zones, which can give you an opportunity to defer the tax and maybe actually reduce it some also. So there are some strategies that you can take to reduce taxes, but you really need to consider there's going to be a dramatic difference between your gross sales price and your net sales price. A few other things you're going to need to consider when you're thinking about your number. One is that while it would be great to sell your business, get a check, and right away into the sunset, chances are that is not going to happen. That would be a very rare situation. So in most cases, if a company buys you out, they're going to want to negotiate a sales price that's going to involve some cash and a portion of their company stock as consideration. So depending on the buyer, it could be that they have stock that you would like to own. So maybe that's a good deal, but you just need to be aware that you're not going to walk away with cash most likely. And if you do take stock as part of the deal, you're going to be tied up for a while. There's restrictions on being able to sell it and things like that. So that's, you need to go in ahead of time with an idea of what you're willing to accept when it comes to the amount of cash that you want up front. The other things that can happen regarding your cash is, one, if you're doing a transfer to insiders or to your family, chances are you're going to end up taking back a note from them, because both of those types of sales, the buyers generally don't have the money to pay you. And in most businesses, again, in the $5 to $20 million range, it may be difficult for them to go out and get a third-party lender to finance the acquisition of the business. So chances are the owner is going to end up taking back a note for a portion of the sales price, and it could be a fairly substantial portion. I mean, we've seen situations. We did one recently. It was a combination transfer to key management and to family, and the note, I think, was it was right around 50% of the sales price came back as a note. Fortunately, this is a very strong business. I don't think there's a lot of risk associated with that, but still, it was something the owner had to consider. The other issue that comes up, especially again in the smaller range of businesses, is that oftentimes the buyer is going to want part of the sales price to be in the form of an earnout. And what that means is, let's just do an example. Let's just say your business, it's agreed that it's worth $1 million, but the buyer is probably going to say, you know what? Yeah, it might be worth $1 million. I'm a little concerned about it from a risk standpoint, so I'm willing to give you $750 upfront, and I'm willing to give you another $500 if the company meets certain financial targets over the next 3 years. So on the buyer side, you have the protection, you have kind of the downside protection. You've only paid $750, and if the company turns out to not be as great as you thought it was, that's all you're going to have to pay. If it turns out the company is doing well, then you're going to pay more, but that's okay because the company's actually turned out to be more valuable than you anticipated. From the seller standpoint, obviously you're taking a risk now because you're not getting your full sales price up front. Instead, some of it is coming in the form of an earnout. Again, if the business does well, you're going to make more than your original sales price, so that's great. But there's risk, which is never, the goal would be to get your money up front, but like we said, chances are that's rarely, if ever, going to happen. We tend to see earnouts almost all the time. There's a third-party buyer. We almost always see earnouts. So that's, again, you need to be aware of that, because you don't want to feel like the guys, the buyer's telling you your business isn't very valuable just because they want an earnout. They're just trying to protect themselves. And then the final thing to consider is, when you sell your business, not only are you not going to get all cash up front, but you're also most likely not going to be able to just walk away. The new owner is going to want you to hang around to transition customers and clients to the new ownership. They're going to want you to help transition employees, suppliers, really all the different relationships that make up your business. They're going to want you to stick around probably for at least 2 years. It's not that unusual to see it stretched out, to 3 or 4 years. So it's important to consider so as an employee, you're going to have an employee contract now. So it's important to think in advance of some of the important things that you're going to need to negotiate into that contract. And I think probably the most important one is the job description, because especially if part of your sales price is tied to an earnout, you're going to want to be in a position where you have authority to make sure that the financial incentives can be met. You're also going to want to have access to the financial records so that you can make sure that there's no monkey business going on with the records, and it'll help you to track how you're doing, to reach the different milestones. So it's very important to negotiate in, your authority, what management abilities you have. Obviously, salary and short-term bonus structure is important. If a larger company has bought you out, then there may be opportunities for long-term incentives like stock options and things like that. Obviously, you're going to want to discuss severance terms. What happens to the earnout if for some reason you're let go, something like that. And like every employee, you're going to negotiate your holiday terms. And another important factor is what happens if the company that acquired your company gets acquired. You want to know if your earnout is going to just accelerate, or if it's going to go on a different schedule, or what's going to happen to your employment. Just lots of different factors. So we always talk about, as you're preparing for your exit, that it's really important to have a skilled team of professionals in your corner, because one thing to keep in mind, chances are whoever buys your company, this is not going to be a one-off event for them. It most likely is a one-off event for you as the seller. So they're going to be much more experienced in acquiring companies. They're going to be much better at squeezing out ways to increase their return and decrease your return. So it's really important that you assemble a team that is going to represent you just as strongly as the buyer is going to be represented. So when it comes to negotiating your employment contract, that's going to be an attorney. And it may be a different attorney than the M&A attorney you're going to need to negotiate the whole sale transaction. We have a good team of employment attorneys that we work with, and we would certainly recommend them. So a lot to think about here when it comes to your number. It's not just the finances, it's also how much cash you're going to get up front, the employment agreement, lots of things to consider. But I think the takeaway is I'd really focus on that first example if you just want to get a back of the envelope idea of what your number is. And I would also just encourage everyone, and can't say this enough in the whole realm of exit planning, start thinking about these things earlier rather than later, so that you're prepared when they come up. So that was it for that. Let's move on to Pat, and he's going to take us into step 4.
Yeah, thanks, Walter. So step 4 is decide the life you want post-exit. In step 4, we want you to start thinking about what you would be willing to do and not willing to do after you leave. You might either be asked by a buyer, or it may be necessary to execute whatever desired exit route you want to go down, that you take on one or more of a number of roles. And roles that you should consider and understand now well before the time you exit. Because it should have impact, as you consider these roles, it should have impact on how you plan and build now for your eventual exit. The first role that many business owners will be asked to play, particularly in smaller companies, would be that of lender. For example, a buyer comes along and says, I'll buy your business, but I don't have all the cash, so I need you to lend me some of the money. I want you to hold a promissory note where I pay you over time. So let's imagine that one buyer approaches you and offers to buy your business for $5 million. At the same time, another one comes along and says, I'll give you 80% up front, or $4 million up front, but I want you to, and I'll finance, or I want you to finance $1 million over 5 years, and I'll pay you 8%, which of course is a very attractive rate of return on investment these days, 8%. Well, this deal, the deal 2 or option B there, could result in an additional $216,000, but it would require you, the seller, to be a lender, and it would require the buyer to be able to pay that $1 million back at interest over time, which may or may not happen. So there's some risk there to you. Also, a scenario where an owner is almost always a lender at some level is with an internal sale to either management or key employees who typically don't have funds to purchase the business. Often it can be necessary for an owner to be willing to be a lender on some level to make a deal work. So start thinking about this now. Would I be willing to be in the role of lender? Okay. Another role you might be asked to play is to remain on board and earn out. And Walter talked about this a few minutes ago, a portion of the sale proceeds. Owners are very often asked by a buyer to stay on for a period of time and earn a percentage of the sale price. Often the case when either the business still runs too much through you, the owner, or the owner thinks the business is worth, the current owner thinks the business is worth much more than a buyer is willing to pay. An earnout puts a percentage of the sale price at risk. It's not guaranteed. So you might have to decide between that that $5 million cash up front buyer, and another who's willing to give you $3 million today with the potential for another $6 million in an earnout for a total of 9. The earnout would be based on a set of metrics, like Walter mentioned, maybe revenue goals, profitability targets. And if you hit the targets, you earn the additional $6 million, you get it. But if you don't hit the targets, you don't get it. So in earnout situations, the additional payout's not guaranteed. The owner is most often now an employee as well. So it can be a very difficult transition for the owner, particularly if the new ownership begins to come in, change the culture, which often happens, and or starts to lay off, long-standing, important, valued employees. It can be a very difficult transition for the selling owner. But an earnout may be the best exit route for you if you need or want to get a certain amount for the business, and it's the only way you can do it. So would you be willing to act as an employee for a certain period of time and earn out a portion of your payout? Think about it now. Another role you might be asked to play is that of consultant. This often happens when the new owner wants to, as quickly as possible, integrate your business into their existing business, and they don't want to keep you on board as an employee for any amount of time. They do want your help in integrating the two businesses, but they don't want to keep you on as an employee. They might ask you to stay on for a period of time as a consultant. So in our scenario here, you've got that same $5 million upfront cash buyer, or with option B, the potential for an additional $300K as a consultant, with $4.8 million upfront and $500K consulting fee paid out over 3 years. So, would you be willing to have a little bit of risk there for some upside? It can look like that. And then the final scenario we'll talk about here is you might be asked to consider being a co-shareholder or co-investor, which is very often the strategy used by private equity firms. It's not unusual for a private equity firm to ask an owner to stay on, provide management as a co-shareholder. You might be faced with a situation where you're deciding between that $5 million upfront or a recap event where you sell 60% for $3 million to this financial buyer, but you're required to stay on to run a company for 3 to 5 for the opportunity for a second bite of the apple. Where in this example, you would again ring the bell potentially for an additional $7 million. But with option B, you have to stick around, which you might not want to do. And of course, there would be no guarantees about that second bite of the apple. So consider now, start today considering, would you be willing to stay on as in any of these roles, really? And which roles would you be willing to stay on or assume, and which ones wouldn't you? Because you might look at all of them and say, you know what, I don't want to do any of those. I want to hand the keys. I want to get a check. I want to hand the keys over and leave. Well, okay, that's fine. But there's a lot of planning to put in place in regard to strengthening certain value drivers of the business in order to provide you that much control. For instance, a strong management team. If you've got a strong management team in place, Walter and I have a client. He can go to Australia whenever he wants because the business runs itself. And so he can easily sell it to a third party. That's just one of the things that are in place. There are other things too. But anyway, the big idea here is start thinking now about what roles you're willing to do, what roles you're not willing to do, and then plan accordingly. Just like in step 1, where you need to get clear now on your why for exiting, in step 4, you want to get clear now on what role you would and wouldn't be willing to accept at exit. So Walter's going to close us out here with step 5 and some closing remarks.
Thanks, Pat. So now, as a wrap up, we're going to take a look at what we call the exit matrix. And I think this can be a very helpful tool. So on the axis that's going north and south, that's the cash proceeds that a seller can expect to get. And the horizontal axis is how much time the business owner is willing to stay on during the transition. So I like to look at this matrix in the context of what we call the 3 universal exit planning questions. And those questions are, when do you want to sell? How much do you want to sell for? And to whom do you want to transfer the business? And let me put this matrix in that context. So if we look at the bottom left quadrant, we have liquidate, assets, fire sale. So this would be a person who would say, I want to get out now, and I don't really care how much I get, and I don't want to hang around. So if that's you, that's what you're looking at. So there's a trade-off. That's the other thing this matrix demonstrates, is there is a trade-off between your willingness to hang around and who you are wanting to transfer to, and the amount of money you're going to get for selling your business. So if you're going to sell to a strategic buyer, that's going to be the most possible proceeds you're going to get. That's someone who believes your business has a strategic value to them as the buyer, so they're willing to pay you top dollar, maybe even a premium to acquire your business. Businesses that are going to sell to a strategic buyer are going to be businesses that are not dependent on the owner. They've got a good management team in place. They've got very solid cash flow. They've got a diversity of suppliers and customers. They've just got a lot of really great things going for them. So that would be, and that, if you're not currently, you can't say that you meet everything I just described. That's okay. If you've got 3 years, maybe 5 years before you want to exit, Pat and I have lots of great strategies to help you check each of those points off as you increase the value of your business and the sellability of your business. So you can see as you go out to the right, if you're going to transfer your business to your kids, in most situations when that's done, the seller understands they're not going to get top dollar, and usually that's not high on their priority list. The thing that's most important is keeping the business in the family. So in that situation, you're probably going to hang around longer to help the transition go smoothly, and you're also going to get less money. And as both Pat and I have mentioned, you're probably going to be a lender also. And the same with the management buyout. You may get a little more money because you're not, you're going to give your kids a break probably. So you'll get a little more money, but you're not going to get nearly as much as a strategic buyer would give you. Recapitalization, you're going to do pretty good there too, because you got a venture capitalist coming in who's identified your business as valuable. So you're going to get pretty decent money there. And obviously, as we've talked about, you're going to be sticking around for a while. So, I think this matrix can be helpful. And again, in the context of the 3 universal questions, if it turns out that when you do the math to get your number and there's a large gap, well, you can think about it. Let's say, okay, well, there's a pretty big gap, but if I can, instead of exiting in 2 years, if I can exit in 4, and I can put a strategy in place to increase the value and sellability of my business, maybe I'll be a potential target of a strategic buyer, which is going to increase your proceeds. Or maybe, you'd really like to transfer the business to your kids, but you haven't done a great job of accumulating assets outside the business. So it's just going to turn out that that's just not going to be a viable option for you. And many times that's not the end of the world for the kids either. So that's a whole nother, that'll be a whole different webinar that we'll do someday, transferring your business to family. So that's it for the exit matrix. I think it's a useful tool. It's something that everyone should take a little while to look at as you're starting to chart out your exit. Patrick, you want to do the last polling question?
Yeah, so we've come to our last polling question. The question reads, what exit strategy are you leaning toward? A, sale to a third party. B, transfer to insiders. C, transfer to family. Please take a moment now to answer. While participants are recording their answers, I will provide the third CPE word. The third and final CPE word is sale. Again, the final CPE word is sale, S-A-L-E.
Okay, sale to third party seems to be the dominant answer. And that's, I think that's good for a lot of reasons. One is you're going to, hopefully get the top dollar, but just keep in mind your business has to really be in tip-top shape if you're looking to sell to a third party, and that's that's something Pat and I spend a lot of time with businesses is getting them ready for sale, and we'd be very happy to help anyone who's on the webinar today do just that. So I'm not going to really spend any time on this slide because I would like to take a few minutes for questions. I've seen a few come in, but basically that was really just recapping the 5 slides that we've already seen. So no point in spending time on that. So Patrick, I think you're moderating the questions.
Yeah, so we have a few questions here that have been submitted by our online participants. The first I will direct to you, Walter. It reads, in general, what is the most important feature of a business that a buyer considers?
Okay, I mean, certain buyers are going to have very specific reasons for acquiring a business, but in general, I think, when we look at building the value of a business, we focus on certain value drivers. And I think the one that owners or the buyers look at, consider to be most important, number one is cash flow. Anyone buying your business is looking at it as an investment. They want to know what their return is going to be, and that's measured by the amount of cash that they can generate from your business. So cash flow, I think, is number one. Also, strong cash flow is just a great indicator that there's a lot of other really good things about your business. And the opposite is definitely true. If there's cash flow struggles, most buyers are not going to be interested in acquiring your business. The other would be owner dependency. If you've got a great business, but it's because you do everything, or you're the one who has all the business contacts and the customers all look at you, that's not going to be a real attractive business to a buyer. Number one, they're going to have you stick around forever. There's going to be a lot of risk involved with whether or not clients transition once you're gone. So to me, I would say those are the 2 biggest factors.
Great, thanks, Walter. We have another question here. I'll direct to you, Pat. In your experience, what are some of the most powerful pulls that drive an owner to exit?
Yeah, great question. Okay. Well, you might think that things like fully retiring, with golf, travel, boats, drinking wine all day, things like that, are powerful pulls, and you'd be right, they are. Particularly for owners who are simply done, quote, or quote, ready to leave. But really, it seems that the most powerful pulls that have staying power, that result in sustained happiness, if you will, after the exit, have a sense of meaning or purpose. Whatever it is, often involves something focused on the owner's particular passion or even burdens at times that requires some level of creativity or service toward others. It can look like, some family project, maybe a legacy project focused on the family and how we're going to transfer values. It might look like service toward others in the community or through charitable causes, philanthropy, that kind of thing. It might be starting a new business or a foundation, but the point is, most often, the most powerful pulls that are sustained long term seem to be those that provide that meaning and purpose to life that successful owner realized in building that successful business. So that's how I'd answer that question.
Great. We'll do one more question briefly. I'll direct to you, Walter. Isn't the worst case scenario, if you do no exit planning, that you die and the business gets liquidated?
Yeah, that is the worst case scenario. And I think they're asking that question because I've had clients say the same thing to me. I think they're asking that question in a way where they're not saying that it's the worst case in a negative way. They're saying, big deal. I'm dead. My business gets liquidated. But that question really ignores the impact that decision is going to have on your spouse, who's now going to be stuck with a business that the minute you died, is now at its lowest possible value, plus not to mention all the administrative headaches of trying to take care of that business and sell it or whatever. Then you've got employees who they're going to be panicked about, is the business going under? You've got customers who may have been loyal customers for 30 years who are now, what are they going to do? So I don't have time to really flesh it out, but it's a very kind of a selfish way to think about that. You really need to be thinking of the impact that your death is going to have on your loved ones and your employees and your team.
Great. Thanks, Walter. Thanks, Pat. If you have any additional questions after today's program, please reach out to us. Our contact information appears on the slide here. And with that, GRF and Ennis Legacy Partners would like to thank everyone for attending today's webinar. We encourage you to always check our website for upcoming events and updates at the link found at the bottom of the slide. Please remember to complete the emailed survey that follows if you would like to earn CPE credit for attending today's webinar. Thank you again for attending and have a great day.